We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Bob Thompson, Senior Portfolio Manager and author. How are you today, Bob?
Great to be on the show with you, Tom. Looking forward to it.
Me too. It's going to be an interesting chat. You know, you have you're really a generalist discretionary portfolio manager, and you focus on the commodity sector. So, you know, I'm looking forward to kind of digging in and asking you how that really gives you a different perspective and insight on the mining sector.
Well, by nature, I'm a contrarian, and you know, a lot of our clientele are senior mining executives, and these people are people that accumulate a significant amount of net worth in a bull market, and then when things go the other side, they want to maintain what they have. So I think it's important to kind of be from the outside looking in, and you know, the old forest and trees example, right? When you can't see the forest for the trees. But if you're looking down and you know there's lots of other options out there, I think it just gives you a better perspective on the mining sector. And you know, although I'm a big bull, obviously in copper, all the base metals, you know, uranium, gold, etc. You know, I realize that it's very cyclical, and this is probably the most cyclical area in the world. And the times when people are the most positive is the point of maximum risk. And the times when people are the most negative is the point of maximum reward. So I think that's important to look at, whether it's stocks, bonds, or in the commodity space.
Yeah, absolutely. And you know, I think that's a really important thing that I think a lot of our listeners want to think about, is how to, you know, keep more of their gains once this gold bull really resumes and the mining cycle gets closer to the top. But we'll kind of go all through that. But as you talk about these cycles, explain to us a bit about, let's say, some sector rotation that you're starting to see right now.
Yeah, you know, I got in the business in 1996, and you know, I don't feel old, but it's shocking because very few people remember the tech bubble of 1998, 99, and all the other issues. But it teaches you a lot, right? And you know, they say, you know, history doesn't repeat itself, but it rhymes. We've all heard that. So nothing's going to be exactly the same as the past. But I see a tremendous amount of similarities right now to what we saw in 1999, 2000. And just as an aside, I mean, all of these issues and these bubbles that are created, and there's probably 6 or 7 of them that I've gone through in my life, are generally created by central banks getting their fingers involved too much and either pulling the plug or putting too much water into the bathtub, either way. So if we go back in time, back to you know, 1996 when I started in the business, in 1997 there was an Asian debt crisis. The Asian debt crisis kind of turned into 1998 Russian debt default, and long-term capital management almost blew up the financial system. I mean, it was almost as bad as the great financial crisis. Now, what did the central banks do? They stepped in, they added a tremendous amount of liquidity. So it makes sense that created a technology bubble, very, very similar to what we just saw after 2020 here. So this technology bubble developed, and you know, the smart people at the time, the Warren Buffetts of the day said, I don't believe in this, the valuations are too high, etc. You know, people called him an old man and said that he doesn't understand the new technology, etc. So he looked wrong for about a year. And you know, I'll just say that, you know, when really, really smart people seem really, really dumb, and when really, you know, people that are uninitiated seem really smart, it's really time to bet on the smart people, because smart people don't suddenly get dumb on the markets, right? So at that time, you know, Howard Marks often says sometimes the difference between being early and being wrong is indistinguishable, and I think that's right. You can be early. And as long as you stay with the trade, usually it's going to work out for you. So back in 1999, the tech bubble happened. We went into early 2000, and obviously there was euphoria in the markets at that time. Now, all the old investors, the Benjamin Graham types, the people that were strict value investors, were all getting fired. right? Because it was the tech guys, the growth guys, because of the easy money that were making all the gains. And people said, we don't pay attention to PE ratios. We don't pay attention to price of sales. As long as the company is growing, it's going to the moon. And it worked for a while. So, and I'm repeating exactly what's just happened in the past year. So what happened is all the value investors get fired, all the contrarians get fired. And usually that signifies the bottom for growth investing when that's the case. So I know in Canada here, a bunch of value managers that were fired last year within a month or two of this big rotation happening. So when the Fed starts to get more aggressive and says they're going to fight inflation or raise interest rates or whatever the case is, then it takes these long-term assets like growth companies and people don't want to own them anymore. So they usually get viciously sold down. The S&P is down around 21%, but there's a lot of companies that are down 40, 50, 60, and 70% right now on the market. And these are these high-flying growth companies. Now, the market has a limited amount of capital. So the capital has to go somewhere. So it starts to go into the more cyclical stocks. So interestingly enough, your typical value stocks, which are the ones with low price to earnings, low expectations, strong balance sheets, et cetera, tend to be highly correlated with mining stocks. Interestingly enough, you think they wouldn't be the same, but they are. And that's what we saw in 2000. Money started to come into gold stocks. And it hasn't happened yet here, but when the rotation starts to happen, it'll happen big.
Bob, what is the effect of money printing and artificially low interest rates really drive the behavior and ascent of growth stocks over these value stocks?
Because the growth stocks are growing their top line pretty rapidly, but they're not making any earnings, right? So and they can borrow a tremendous amount of money to make their top line look better. So people see these top line growth going in these companies, and then people say, okay, well, one of these days, they'll equate that into earnings down the road. Well, if they actually can't get there, and then the cost of capital for their growth becomes that much more expensive because interest rates start to go up, the company dissolves usually because there's high leverage. There's not a lot of cash flow, and they're not bad companies, right? And there's nothing against these companies. I mean, take advantage of it while it's there. But a lot of them get exposed, as Buffett says, you don't know who's swimming naked till the tide goes out. A lot of them get exposed when the cost of capital becomes greater, and that's the rotation that we're starting to see in the market. Value stocks are doing extremely well, and a lot of the mining stocks are, except for gold, right? I mean, copper stocks have done fine. There's been some great discoveries, zinc, lithium, all these areas, and gold will have its day too in the near future.
Can we look at the ratio of the price of the S&P relative to the price of gold to show us the valuation of gold and give us some sense of where it is in the cycle as well?
Right, we can, and it takes a lot to be a contrarian, right? I've heard contrarian investors say a lot of times that when you buy something, unless it makes your stomach turn because you think it's the wrong thing to do, then it's you might not be making the right move. If you feel good about what you're doing, it's not good. So that's what we see in gold and S&P 500 right now. So we're at about the levels that we were back in 1999. I know a lot of people say that the gold to Dow ratio should be 1-to-1 or whatever the case is. Now that would be a stretch, but if it just goes back to the norms, that shows either that the S&P 500 has to go down a tremendous amount or that gold will rise substantially. And I think they'll be kind of somewhere in between. Remember that, when we get good commodity markets and when we get good gold markets, it's no coincidence the stocks don't do well because it's underlying reasons where that's the case. So it's 1966 to 1982, the S&P 500 had zero return for 16 years. Incredible. And we know what happened with commodities during that time frame. And it isn't a coincidence. It's not like, wow, gold went up and copper went up. What a coincidence that stocks went down. The reason is because the input costs, inflation, causes the earnings of companies to get squeezed. Right. So if you're General Mills, for example, or Kellogg cereal, and your grain costs and your cost of input, your commodities goes up, you can raise the prices to the end consumer to a degree, but usually not as much as your underlying costs go up. So your profits get squeezed. Well, if that happens over a decade or so, stocks are not going to do well because profits are getting squeezed. So commodity markets and general equity markets tend to be inversely proportional, and that's for a reason. So we could go back many years. Let's go back to 2000, right, where I kind of think we are right now with regard to commodity markets and stock markets. Is the China demand that drove the last commodity market from 2000 to 2010, 2011. The S&P 500 was flat for 12 years. People forget that. From 2000 to 2011, 2012, the S&P 500 was flat, while commodity markets did extremely well. Now we've had 13 years of outperformance of the S&P 500. Commodity markets haven't been a great place to be for a long time, but that's starting to switch again. So, we could be in for a 10-year bull market here in commodities, including gold, oil, et cetera. And I wouldn't be surprised in, a few years if the S&P 500 kind of flat.
Mm-hmm. So, Bob, this chart really kind of shows the cyclical trends of equity performance versus commodity outperformance, as you were just talking about, right?
And again, it's no coincidence that these markets are inversely proportional. So, I didn't live through the 73, 74. Well, I lived through it, but I wasn't in the markets. I was having fun as a 6-year-old at that time. But, during that last big kind of blow off, or second last, in 1969, where there was these stocks called the Nifty 50 stocks, right? These were the high flyers of the day, the Polaroids and Kodaks. And interestingly enough, not many of them are around anymore. But those were the high flyers of the day. Commodities had kind of a horrible run. Then we got into the early 70s, and we've talked ad nauseum about the gold standard and Nixon and everything that happened there. But we see that over that decade, the 70s, commodities did extremely well. And again, it's no coincidence that stocks didn't, because stocks were having their profits squeezed at that particular time. Again, inflation, if your input costs are going up because of inflation, you can't necessarily pass all those costs on to the end consumer, and it reduces demand, so you get squeezed. So we had this great commodity market in obviously the 70s that blew off. With gold at 850 in the early 80s. Then we had this terrible bear market for stocks, and you saw the magazines all said stocks are dead. You'd show a bull on the ground that was dead with a stake through its heart or something like that, and that was the bottom for stocks. So then we had this 19-year phenomenal bull market from 1982 to 2000 in stocks, and generally speaking, bull markets end with some sort of speculative bubble. All right, so commodity prices were under pressure for a long time. It's a tough place to be. And then we had this speculative blow off in the late 1990s, 1999, 2000. And what's interesting is after these speculative blow offs, whether it's in commodities, whether it's in equities, you do tend to get another sector that leads you out off of the other side. Mm-hmm. So it isn't the same sector that had the speculative blow off, because we can talk about in a second, how people go wrong in bull markets and how people go wrong in bear markets as far as understanding what to trade. So then we had a 10-year commodity outperformance, and I live in Canada here, and I always say 2000 to 2010 was Canada's decade. Right, oil, gas, gold, all the industrial metals had a good run, and most of those are obviously listed here in Canada. So it was a great run. That kind of topped out in 2011, 2010. Now we had this great stock bull market again, which ended in a speculative blow off in the technology stocks, the same as it did in 1999. Now you see we're at the beginning of some outperformance of commodities as far as I'm concerned. And most of that run that you see there already was oil, right? The other ones really haven't run that much. So if you take out energy, we haven't really even started yet. And if we do have a decade-long commodity bull market here, the results can be pretty spectacular on the upside.
Mm-hmm. Bob, as you're mentioning this kind of compression of of margins for gold mining companies, let's say. How do you see that translating back into acceleration of their share price? If we're seeing, sustained high oil prices as the main input cost to mining, how does that resolve itself in a higher share price for these companies?
Right. So I mean, what has to happen if you do get profit compression because of rising input costs? You have to get a higher level of price of the commodity that you're selling, right? And generally speaking, gold will catch up. So that's why people look at things like the gold to copper ratio, right? The gold to oil ratio, the gold to the S&P 500. But yes, input costs are important, and obviously they're getting squeezed a little bit right now. But I think as we can talk about when the Fed's going to turn and rotate. That's when gold usually does pretty well. But you don't get explosive profits forever. Something starts to happen, and there is something called the mining clock that I talk about. We can go through that, where what happens as the cycle goes on and the decisions that companies make, which ultimately end up in a bear market starting. Right, we're early on in the gold cycle here. We're early on in the commodity cycle, but it's very, very important to understand the whole cycle and to see what's happening as we move along.
Mm-hmm. Well, before we get to both of those, I want to spend a little bit more time maybe on inflation. So how do you see the difference between the environment, let's say pre-COVID, where we saw lots of money printing and mainly asset price inflation, versus really post-pandemic here, where we got much more consumer staple inflation?
Right. I think the world had become accustomed to the fact that we could just print as much money as we wanted to, and it miraculously wouldn't cause inflation. Right. Now, we all know that the CPI inflation numbers are calculated differently than they were in the 1980s. If they were calculated the same, we'd actually see significant inflation, but we'll just go with the numbers that they put out. I think one of the big reasons is, remember in the great financial crisis, 2008, 2009, consumers weren't bailed out, right? It was the financial system that was bailed out. Trillions of dollars of money went into these financial companies because they figured they were too big to fail. Everything was going to collapse and that's debatable, but that's what happened. So the money didn't really get put into the consumer's hands. This time was completely different. They put the money directly into the consumer's hands. And I think that's a trend because of where we are kind of in our social economic situation here. I think that's a trend that's going to continue. Consumers expect to get bailed out now. So obviously, when you put money in consumers' hands, the U.S. has 75% of the economy is consumer based, basically going out and buying. They're going to spend money. Now, I think we would have had inflation. Obviously, we've had some supply chain issues and the war and all that sort of thing, which wasn't the cause of this inflation, but it was just an add-on that's made things a bit worse. So that's the big difference I think that we see. But right now, I think that the inflation is getting to be structural, and that's what the Fed's very concerned about, right? A lot of people we all criticize the Fed all the time, but I heard somebody a little while ago. He says, the Fed's kind of not as clueless as we think they are. They know exactly what's going on, but they have to have a certain narrative, right? You can't say, oh my God, we're going to have a terrible recession next year, because you just created it, right? You can't say that inflation is embedded and we're going to have serious inflation forever, because you just made it happen. Everybody's going to go out and buy things to try to beat inflation, which is going to make inflation worse. So you have to kind of crush those expectations of inflation. And that's why they're so aggressive right now. But the problem is that it's becoming structural. And when it becomes structural, when it becomes embedded, then people expect there to be inflation, which makes it worse. So usually by the time you see inflation, some serious inflation, it's kind of too late. And you got to pull the tools out of your toolbox to end that inflation. But, we can't do what they did back in 1980 when there was, 30% debt to GDP at that time. Today is 120. Debt to GDP plus all the private sector and pensions and then that sort of thing. So you can't raise interest rates up to 18 to 20%. And, I heard a couple interesting things the other day, which really I think are important for people to pay attention to. Two rules have never been broken. And I think one of them is about to be broken. But the two rules are, if inflation gets over 5%, basically the only way you reduce the inflation significantly is to have a recession. Mm-hmm. And sometimes it's a serious recession. So, that'll possibly happen this time. The other one is that you've never really beaten inflation over 5% unless the Fed funds rate gets raised to a level above inflation. So you'd have to have the Fed, if inflation is 7 or 8% right now, you'd have to raise the Fed funds rate to 8%. Well, that ain't going to happen, right? Because there's too much debt in the world that would collapse everything. So that rule might not stand the test of time. But interesting enough, those two rules have survived for decades and decades and decades.
Mm-hmm. So do you think that they'll, with tightening monetary conditions into this weakening economy, do you think that that'll actually work to kill the inflation that we are experiencing?
No, and in many respects, not, because it's already becoming embedded, right? You have to raise rates a lot more than I think they have the ability to do. Mm-hmm. Few people remember that the saving grace to too much debt is negative real rates, right? So we're in an approximate debt situation like we were at the end of World War II. And that was important to have debt at that time. I mean, if we lost the war, that would have been a problem. Right. So obviously it was important to build that debt and win the war, which was done. But real rates of return in the late 1940s for about 6 or 7 years were astronomical. They were very, very big. And it kind of worked off the debt. Now, at that time, we had the 1950s of all the soldiers coming home and baby boomers and all that sort of stuff, which was great demand. Now, we don't have that demand this time. Demographics are different. But it worked at that time to pull down the debt, because you could have negative real rates, you could have inflation running above bond yields, and you had the growth to pull yourself out of it. We don't have that this time. Mm-hmm. But the problem is, in the world that we live in today, our input costs are still the same as they've always been. So although we all want to get off carbon-based fuel, it's a multi-decade process to do that. So if we tell people they're not allowed to invest in that sector, or the companies that they're not allowed to invest, then the oil prices go up dramatically. And I think we can talk about this more later, but I think the oil is kind of the first one. It's also happening in the metals sector. People don't realize. I heard Robert Friedland one time, a mining magnate in the world. He said, "Sometimes I wonder where the guys on Wall Street think they got their ham sandwiches from." He said, "I think they got them from the fridge." Mm-hmm. Right? And these input costs, I say to young people all the time, look around you, look at everything around you, either comes from above the ground or below the ground. Mm-hmm. Everything, your desk, your windows, your construction, your wood. And if you have malinvestment in that area, either bad investment in that area or no investment, a lack of investment, then you're going to get sustained high prices. And that's going to be an issue.
Mm-hmm. So Bob, you mentioned what might make the Fed pivot at some point here in the future. Mm-hmm. What do you think that is going to be? Is it going to be credit markets blowing out? What is going to force them to go back on their hawkish stance that they've taken?
Well, I think they're going to have to decide between a very, very severe recession or sustained high inflation. Now, sustained high inflation doesn't mean 9, 10, 12, 18, 25% or hyperinflation. It could be 4 or 5% when interest rates are lower than that. So there's a negative real return there. And I think they'll choose to have some sustained higher inflation rather than an economic depression. And they are, we've all been saying it for a long time that the Fed is backed into a corner, right? But they continue to kick the can down the road. They continue to readjust the chairs on the Titanic, right? Thinking that it's going to be different. But to this point, they've been able to pull all the tools out of their toolbox and actually, keep things running in a proper fashion. And I think we're getting closer to the time where they run out of tools, right? And the inflation is the catalyst for that. So I don't think it's politically acceptable. It's certainly not socially acceptable in this day and age to have a severe recession. Because that's something we might not be able to get out of. What if housing prices went down 60 or 70 or 80%, right? Mm-hmm. I mean, it's going to wipe out most of the people. So they can't do that. So they have to choose one or the other. And, I think they'll choose some sustained inflation. But what possibly come in if we look at in the 70s again, right? They had rent controls, they had price controls, they had wage controls, right? So you tell companies that they're not allowed to charge more than oil companies, they're not allowed to charge more. And obviously that always ends badly, but I can certainly see that coming into play again.
Mm-hmm. You shared a quote with me earlier that it seems really prescient to these times. If you'd like to repeat it again there.
Yeah, it's a long quote, but I think it's important if people remember it. Man's name is Alexander Tytler, and he was an economics professor, believe it or not, in the year 1780, so in the late 1700s. And I think it's important because we've all heard of tulip mania, we've all heard of these bubbles that have happened in the past. And I think the reason it's important to look at the past is people don't change, right? We're no different today than people were in the 1700s. They were just as smart as we are. They just didn't have computers and this sort of thing. But that's why I think it's important, this quote. Alexander Tytler said, "A democracy cannot exist as a permanent form of government. It can only exist until the voters discover they can vote themselves large amounts from the public treasury. From that moment on, the majority always votes for the candidates promising the most benefits from the public treasury, with the result that a democracy always collapses over loose fiscal policy, always followed by a dictatorship. The average age of the world's great civilizations has been 200 years. These nations have progressed through this sequence, from bondage to spiritual faith, from spiritual faith to great courage, from courage to liberty, from liberty to abundance, from abundance to selfishness, from selfishness to apathy, from apathy to dependence, and from dependence back into bondage." So, I think at this particular time right now, we're probably in that dependence stage, right? We're running over $1 trillion deficit when supposedly the economic times are great. The economy's never been stronger. Unemployment's low, economy's robust, and we're running over $1 trillion deficits. What's that going to be when, because people still want the handouts, right?
Mm-hmm.
It's just a function. I think for many, many years now, we've been living above our means, right? People expect to have a certain level of goods, services, et cetera, which really as a society, we can't afford. So we can continue to afford it as long as we can create new money and pretend, but sooner or later that doesn't work. And I think one of the reasons that we're in this social, economic, and this turmoil that we're in right now in the world, and the left and the right, and all these issues that are happening is caused because of this, right? We're all living in to a degree above our means, and it just isn't there anymore to support our wants. And but what starts to happen is individuals say, well, I deserve this and I deserve this, et cetera. I deserve my pension, which is fine. Everybody can. So they're going to vote for the government that promises that to them. And, you can't pay for it. So you can only do it for a short period of time. So Social Security, Medicare, all of this stuff is under pressure. Mm-hmm. And nobody wants to give it up.
Bob, we've talked a lot about the US here, really, and you have, again, somewhat of a unique perspective being Canadian. And I've had some Canadian listeners recently ask if there's any appreciable differences that you can think of when it comes to, building a portfolio or housing prices, whatever it may be, that is different from the US. Obviously, the US policy affects the rest of the world in a lot of respects, especially in the financial markets. But are there any considerations that you think are different for Canadian investors than US?
There are in the short run. That's right. And, I did a book many years ago, and one of the guys I interviewed in the book was Eric Sprott, who's obviously a big name in the mining sector. And I asked Eric that question about Canada and the US. I said, what do you think? And he goes, well, I don't really pay a lot of attention to what's happening in Canada, because he said whatever happens in the US happens in Canada 6 months later or a year later, which is true because it's a big export market. Now, having said that, we do have some issues in Canada. I think that the Central Bank of Canada is even more constrained and more in trouble than the central bank in the US, because up until recently, they hadn't really embraced quantitative easing. But after the 2020 situation, they went and bought 35% of all the outstanding Canadian bonds with printed money, right? So that's been done. We never had a 2008 housing crisis here, right? It dipped, but then it continued going up. So now if you look at the US and Canada, the housing crisis here in Canada is astronomical compared to the US. And, it's very debatable, but a very large proportion of the Canadian economy is based on housing, right? Not just realtors, but it's based on construction. It's based on the lawyers that do the transaction. It's based on transfer costs and taxes and all this sort of thing. So a very large percentage. So, in Canada here, if the real estate industry collapsed completely, I think it's kind of like a too big to fail sort of event. So who knows what they might have to do here in Canada. What other governments in the world are doing is starting to pay people, pay their mortgages, et cetera, right? I mean, Australia, they have a program now, because Australia and Canada are very similar. Australia's in a situation where, this is a very, very, very loose kind of story here. I'm not going to go through all the details of it, but the Australian government is helping to pay people's mortgages. Right. In California, you see they're sending out checks to people to pay for their energy. Right. Here in Canada, I wouldn't be surprised if in some form they start to help people with their mortgages, whether it's tax rebates, whether it's directly paying for the mortgages. In Britain, they said that also. They said renters should be allowed to own houses. So the government's going to help a renter to kind of move that into their own home, which is great from a social perspective, but, bear markets are meant to clear out the excess, right? They never did that in Japan. And here we are 30 years later with Japan in the situation that it's in, right? So you can't, you got to clear out the deadwood and you got to start new. And that's why we had such a phenomenal bull market for stocks in the US from 1982 to 2000. Because that deadwood all got cleared out in 1980, 81, 82 with those interest rate increases. But I just socially don't think that people are willing to accept that these days. So there's the differences between Canada and the US. The big one is the housing.
So, Bob, I'd like to move on to a little bit about more like how you think about, let's say, strategic allocation, how you build a portfolio.
Right. And I think this is very important because very few people know what's going to happen to the market in the next 6 months, right? Or whether it's gold, whether it's copper, whether it's the stock markets, whatever the case is. And whatever you think is usually the opposite, especially if it's consensus, right? Markets, only a very small amount of people can become wealthy, right? When you think of it mathematically, not everybody can become wealthy. You can't run around with everybody in the country that's worth tens of millions of dollars. It doesn't happen. So there's only a small percentage of the people, which means that that being a contrarian and doing things differently than everybody else is the only way to really succeed. And I pay a lot of attention to sentiment. So when everybody's talking about a certain area, I usually stray away and go somewhere else because the profit potential is not there. So that's why the strategic asset allocation, I think, is very, very important, because it takes away the emotional aspect and helps people to create these portfolios that are, I don't want to say bulletproof, but do pretty well in any sort of market environment. And again, I'll use gold as an example here. I'll say I'm just coming up with an example of 10% in your portfolio. Of course, this isn't advice. Everybody's got to make their own decisions as far as what they do, their risk, reward, et cetera. But we'll just arbitrarily say that somebody wants 10% of their portfolio in gold, for example. Well, if gold doubles, or your other investments in your portfolio go down 50%, and gold is now 20% of your portfolio, well, pull it back to 10, because your target allocation is 10. Mm-hmm. If you want gold as 10% of your portfolio and it collapses in value or everything else moves up a lot and only becomes 5% of your portfolio, well, then double your position up to 10%. And miraculously, we're actually doing what we should be doing. We're selling when it's high and we're buying when it's low, and we're not letting emotions get involved. And that's what strategic allocation is not trying to focus on what's going to happen to the market, but just saying, I know how certain things perform in certain market environments. And usually when stocks do really well, then gold doesn't do well, and the other way around. So rebalance back to my target, and it makes life a lot easier and makes people do a lot better decisions over time. So that's kind of the analogy on strategic asset allocation. Nobody knows what's going to happen in the next few months, and worries like a rocking chair, right? Keeps you busy but doesn't get you anywhere. That's what I always say. So worry about the things you can control, and what you can control is what your target allocation is, how that's going to affect your life. Don't worry about things you have no control over.
Bob, we've talked a lot about gold already. Do you see this bull market as still intact? And maybe if you could give us some perspective on the current pullback that has lasted, let's say, nearly 2 years here.
Right. I do think the bull market is intact, and that brings up a great point, because secular bull markets last a decade. Okay, there's a certain way that you can identify a bull market. There's a certain way that you trade in a bull market. Bear markets are usually shorter duration because they're more violent on the downside. There's a lot more panicking, et cetera. But let's just kind of go through when this bull market started in gold, the end of 2015, right? So 2011 to 2015 was about 4 years, about half the time of the bull market. Gold reached about 1,050 at the time. And ever since 2015, we've been getting higher highs and higher lows in gold. And I think that's extremely important. And that's the definition of a bull market. So on the charts, we're still in a bull market, right? We can sustain levels, significantly below what we have right now and still be in a bull market. And I think this is really important from a trading perspective. You have to kind of identify whether you're in a secular bull market or a secular bear market, and then trade accordingly. So for example, if we agree that we're in a commodity bull market or gold bull market, then what you do in that bull market is you buy the dips, right? You buy the dips, you accumulate more, and then you ride it all the way for the bull market. In a bear market, but what happened? Let's just say right now what's happening, for example, is a lot of these growth companies, people have been rewarded for the past 10 years of buying the dip with the S&P 500. So you become so ingrained that you're smart by buying the dip, right? You start to mistake brains for a bull market, right? You're not the smartest investor in the world. You just had a great bull market behind your back. You have to understand that. But people have been rewarded for these for buying the dips. So what happens? And I don't know if this has happened or not, but you start to go over the top. Then what you start to do is you get into a bear market. So if we're in a bear market, what you're going to do is you're going to get lower lows and lower highs. So you're so accustomed to buying the dip that you continue to buy the dip in the bull market. So the market goes down, you buy the dip. You're rewarded because you get a bear market rally for a short period of time. And then it goes lower and you buy the dip again. And then you get a bear market rally. And then it goes lower again. So after about 5 of these, which is what happened in the tech bubble in 2000, there was some vicious bear market rallies there where stocks rose dramatically and then gave it all back and down again. So generally speaking, by following the principles of buying the dip, which is what you do in a bull market, if you do that in a bear market, you continue to buy the dip. So at the bottom, you have no money left and you're probably out of money, completely bankrupt, and you give up, right? So then what happens is that is such a painful process that you learn, okay, I'm not going to buy the dips anymore, right? I'm going to sell the rallies because that's what you're supposed to do in a bear market. And you look and you say, oh, these rallies happen. I should have sold the rallies and I would have made so much money. So then the bull market starts again on the bottom and you get a big rally. And what's the first thing you do? You sell the rally. And then you miss the next 300% or 200% in the bull market, right? So you kind of got to know whether you're in a secular bull market or a secular bear market. Now, in gold, I think we're in a secular bull market, right? So buying the dips is the thing to do. It's painful to do. And if you look back You look back in the 70s, or you look back from 2000 to 2011, it seems so obvious when you look at the chart at the time. You say, oh man, if I had bought all these dips, how well would I have done? Well, I think we're in that environment again. It's debatable. You never know until you're well into it, but we might have started a secular bear market for stocks. So the more people dive in and buy these dips, the worse things are going to get for them.
Mm-hmm. So, conversely, like, let's say as a proxy to the gold price, if we're still in this gold bull market, we want to think about how we're taking advantage of the mining stocks for those investors that are interested in that. So you have a visual representation of the mining cycle in something you call the mining clock. So if you could walk us through that, please.
Yeah, if you want, we can take a look at that on the screen. I think this is very, very, very important because, again, it tends to help you eliminate the emotional part of the market. And it helps to see what's happening in the market, what the financing cycles are, what the credit cycle is. And that kind of tells you how far along we are in the cycle. As we all know, credit leads equities, right? And the reason for that is if you have access to credit, companies can then spend that money and grow. So I'll keep coming back to that as we go through this mining clock here. So we'll start at kind of 1 o'clock. And if I was to go back in time, I would probably say 1 o'clock was 2012, 2013 in the mining cycle. So because of what happens late in the cycle, usually companies' balance sheets don't look great. They've overpaid for a lot of acquisitions and they have a lot of debt. And especially in the mining sector, because, as far as the mining sector is concerned, it's one of the only businesses, oil and gas also, where you have a depleting asset. So if you have 30 million ounces of gold, as far as your reserves, and you're producing 6 million ounces a year of gold, you don't have a company in 5 years. You have no assets unless you go out and find some more. So companies usually are kind of bloated on their balance sheet at 1 o'clock. And what happens is the price of the underlying commodity goes down. So now it costs you $1,500 an ounce to produce gold, and you're selling it for $1,000. Not a very good business. You can't survive very long to that. So you start cost cutting dramatically at the start of a bear market to survive, basically. And you've got it's funny because 2008 happened, and then 2011, 12, 13 happened, and you had big companies in the commodity space that almost went bankrupt twice within 10 years. So then at 2 o'clock, some companies don't make it. And you do get liquidations, right? You see that in the junior mining space quite a lot, obviously, because there's no cash flows that these companies have. But even with the big companies, you can't continue to have bloated costs and selling for lower. So you get these company liquidations, and that's where a lot of these smart investors, like the Lundins of the world and company and families like that, will come and buy assets for very, very, very cheap from these big companies. A company paid $1 billion, and these people will buy it back for 200 million and sell it back to the majors for $1 billion down the road. But you have to have cash at the bottom, and nobody ever has cash at the bottom. That's the underlying thing here. I used to be the alternative investment strategist at my old company. So I would advise people on hedge funds and alternative investments to buy. And I always said the only reason why hedge funds ever go under, and it's the same with companies, is because of excessive debt and illiquidity. Right? So you can't get rid of your assets, and you have too much debt, and that's a toxic cocktail. And that's what can cause companies to be liquidated. And that happened in the last cycle. And it's a good thing. And I don't mean to sound harsh, but it's a good thing because you got to clear out the deadwood so that the capital, when the market starts again, will get deployed into companies that should have the capital to go out and find some more assets. And if you bail everybody out, like right now, we have no bankruptcies in our economies in North America. That's a problem because everybody's been bailed out. Right. So capital is not going to flow to the good allocators of capital. Right. You have to have these washout sort of events. So you have company liquidations, which is great. At number 3, You get asset write-downs and credit downgrades. So credit analysts are always kind of late to the party. And now they will look at a company and say, oh, we better write down this person's debt. They're going to have to pay more for their debt because their balance sheet doesn't look very good. The companies, on the other hand, are saying, wow, this gold deposit that we bought for $1 billion when gold was $1,500 an ounce. Now the gold's $1,000 an ounce. It's really not worth $1 billion anymore. So we got to write down those assets to nothing, or to 100 million or 200 million or whatever the case is. So that's the next stage that happens. That was all through 2014 into 2015. That started to happen. And those are some pretty horrific times for the industry. But as you see on the mining chart here, on the mining clock, that's the time to look. That's the time to say, okay, who's going to survive? What's the good management? Who's getting rid of their corporate jets? And let's buy some of these companies when things stabilize. So then you get to 4 o'clock and metal prices tend to stabilize. And that's a great thing because companies have now brought down their cost from $1,500 an ounce to $1,000 an ounce, for example, right? So gold is 1,000, the costs are 1,000. Now at least they're breaking even, all right? Then the industry's recap. They now have some access to capital, and they'll say, "Okay, good. We'll go out. We'll borrow a little bit of money here because we can now." At 1, 2, and 3 o'clock, they couldn't borrow money, right? Nobody would lend it to them. So if you don't have access to credit, things are really, really tough unless you do something to your company, like either liquidate or write down your assets. So you start to get some access to capital at 4 o'clock. And the markets stabilize. Then the price of the underlying commodity starts to go up. You start to get cash flow positive, and at 5 o'clock, the debt starts to fall. So you can say, okay, we can breathe a sigh of relief now because at least we're not going to go bankrupt. We're getting some positive cash flow. That starts to happen, and then of course, as time progresses, these mining companies say, "Well, this is great now. Now we're actually got free cash flow." Our debt is at a lower level than it could be. We're a little bit, more confident about the price of the underlying commodity, but we have a problem. And our problem is that, again, this is a depleting asset. So unless we go find some more assets, we're not going to have a company in 5 or 6 years because we're producing everything that we have. So that's where you start to get cash takeovers because they've got cash. And they start to say, okay, now we're going to go out and buy some great projects out there for cash on the balance sheet, because usually you can get them fairly inexpensive early on in the cycle. And that's great. You tend to increase your reserves, and the good companies get taken out, the small companies. Then what happens is the sector starts to improve rapidly. People want to invest money into it, whether it's credit or equity. And you get lots of great management teams that start out small companies, and they say, "Great, we've got a mining district here that hasn't been looked at for decades. Let's go drill. Let's find some more gold." And with that comes the financing, and I think this is really important. The access to credit is what makes the great discoveries happen, right? There isn't a lot of great discoveries from 1 o'clock till 5 or 6 o'clock. And it's not a coincidence. The reason is because you don't have the capital to go out and actually find a great discovery. So you need the capital. Once people are confident that you're going to get the capital, then what happens is exploration starts to rise because you get the capital, you put it into the ground, and then miraculously we start to find some great discoveries. And these great discoveries tend to happen in the latter part of the cycle, midway through, or the latter part of the cycle. Then what happens is debt starts to rise. So when debt goes up, companies now rely upon the fact that the credit markets are there. They can get access to credit anytime they want to. Then usually the stocks have gone up in price significantly that they decide, okay, we're going to take out some debt so we can buy another company. But the company's prices have actually risen to a point where they can't really buy out with cash anymore. So they do something called the paper takeover. And that's when I get always a little bit cautious when you start to get all paper takeovers. We're going to use our overvalued stock to buy your overvalued stock, right? So case in point, and I'll stop there at 9 just for a second. Let's go back to the cannabis sector in 2017. All right. It's the same cycle. You could have called this the cannabis clock. But at the time, I had people saying to me, Bob, when the stocks went vertical back in last quarter of 2017, people said to me, Bob, you just don't understand. I mean, the barriers to entry of this industry are going down. I mean, the amount of demand is going to be incredible. Governments are going to make marijuana legal. They're also also it can be used for medical purposes, all this sort of thing. It's just incredible what's happening with this sector. So I said, okay, let's just step back as a generalist, again, because I wasn't a cannabis person. I didn't understand that sector per se, but I looked back from a generalist and I said, so what's happening in this sector? And one of the big things that was happening was a company that was worth $1 billion 6 months before was now worth $6 billion. And they used stock to buy a company that was worth zero 6 months before, that was now worth $1 billion. And they used a paper takeover. There was no way they should have been able to buy a company for $1 billion. But the only way they could is because their stock was so overinflated. They were able to buy the $1 billion company. And when I saw that starting to happen in earnest, I said, okay, I think this is what I think is going to happen over the next 5 years. I said, I think over the next 5 years, people will be using a lot more, cannabis than they are now. So there's going to be growth, but I think the stocks will be down 80% in value. And people said, are you crazy? How could that be? And I said, because there's too much supply. We're late in the cycle. And I learned that from the technology cycle back in 1999, 2000. Do you think the internet changed the world? Well, yes, it did. The internet, of course, changed the world. So the thesis was correct back in 1998, 99, and 2000 that the internet would change the world. The thesis was correct. The problem is that you just lost about 80% of your money by investing in that thesis, right? So that was the same, and it'll be the same in mining in a few years, right? And that's one of my jobs, is to keep track of this so that people don't do the round trip in the mining cycle. Because if there's any cyclical cycle in the world, it's the mining cycle, and the reason is because you got to spend a lot of money today for no reward for about 5 to 10 years. That's when you're going to start producing for the money that you spend today, and who knows what the prices are going to be at that time. So you get the paper takeovers, always a big danger sign. We've had some in the mining sector, but they've been big ones, generally speaking, big paper takeovers. They're not buying people at 50% above their value, and we've had no euphoria yet. Big people leave companies at 10 o'clock. So the big people, or the people that work at these big companies, say, the excitement's in the juniors. So you get all these geologists and people leaving and starting up new companies. That's another danger sign. And then you get to 11 and 12 o'clock. And I think you would agree with this, Tom, that if there's one thing that governments are not, they are not proactive, right? Governments are reactive. And I think that's one of the big things with the Fed right now. The Fed is reactive. It's not being proactive. So at 12 o'clock, governments look and say, and it might be happening, it's happening right now in lots of different areas, maybe in energy, but these governments say, the cash flow, these companies are making way too much money. So we're going to raise taxes dramatically on these companies. And they usually raise the taxes right before the big crash happens, because of all these other areas. So that, I think the mining clock is, it's not 100% every time, but I think it's really good because it is a credit clock. It lets the market tell you how far along we are in the cycle and what's happening in the market. And, there's a theory in the market, it's called the theory of reflexivity, which basically says that the market controls the economy, not the other way around. And there's a reason for that. It's access to capital.
And of course, this mining clock doesn't just, let's say, apply to gold miners. It also applies to, let's say, the entire mining sector as a whole. So you're very bullish on uranium as well. So maybe tell us a little bit about why that is and how the mining clock applies to the uranium sector as well.
Sure. I see. You see, it's at 6:30 right there. That's probably for gold mining. I think for uranium, it's a little bit further behind that. And I think it's important. But uranium is a bit of a different sector, and I actually have a different clock which shows specifically for uranium, and that's because there's a long-term contracting cycle, and there's a spot price, and there's some intricacies because of that long-term contracting cycle. But the fact is, one of the first things I do is I like to invest in any sector or look at any sector that's down 80% in price. Because we all know if something is down 80%, you have to make over 400% to get back to where you started from. So it's a very asymmetrical return profile. In other words, there's that much downside and there's that much upside. And all we have to do is wait. So I became interested in uranium 2 or 3 years ago, way before these markets started to move the way they have, because I looked and I said, here's something that 20% of the power in the U.S. is nuclear. People all hated the industry at the time because since Fukushima, in Western Europe, upwards of 70%, and in some countries is nuclear power, and you need uranium. Because of Fukushima, there had been zero capex, right? In going and finding new uranium in a depleting asset. Uranium prices were far lower than the cost of production. So I looked at that and said, I didn't know that Sprott was going to get into the market and start buying on the spot market. I didn't know all of this at the time, but I had something on my side. And what I had on my side was time arbitrage. And I like to call it that because I knew, or I suspected, that uranium prices would have to rise significantly to pay for the baseload power of the nuclear energy creates. I just didn't know when that was going to happen. Right. So I was willing to wait 1 year, 2 years, 3 years, 4 years, 5 years for pretty outsized returns. And I call that time arbitrage because very few people these days are willing to wait. Right. They want instant gratification. Right. People love Twitter because you can read something and take 10 seconds and get some information from it. Right. So people want that instant gratification. And I also think, that hedge funds rule the market. And hedge funds get paid quarterly performance bonuses, okay, based upon their performance for the quarter. So they're very rarely are they going to say, I'm going to buy an asset today, and I think maybe in 3 years it'll make us a lot of money. They won't do that. They want to invest in what's going to make them money now. So a lot of retail investors listen to your presentation here, your channel, and I would say that in today's world, with all the algorithmic trading and all the computer-based trading that you're competing against, as a smart retail investor, you have a fantastic advantage, and that is that time arbitrage. If you just look out a year and a half, 2 years, 3 years, and say, what's things going to look like at that time? You can make some outsized returns when everybody gets there. So that was the thesis with uranium. Obviously, it's a very opaque market on the spot market. Nobody quite knows how much was on the spot market, and Japanese utilities were selling into the spot, et cetera. But all of a sudden, Sprott came in, they started to suck up the spot market. But since oil prices have gone up, everybody has got so positive on uranium now. And this is a long-term secular trend, right? They're not positive on uranium, they're positive on nuclear energy, which obviously uranium is a necessary component for that. So that's why I'm still positive on the sector. But I think what's important is the prices have not risen substantially up to highs yet, right? We're still less than half of what it was back in the last bull market. Whereas a lot of the other things, it doesn't mean that something that is near a high isn't going to go any higher. I mean, agriculture's, you look at those levels, 100%, 97%, 97%, they can still go a lot higher in an inflationary environment. But something that you can buy that's half, and you see silver is the other one that's pretty positive on, it pays to wait because the returns on these investments are so outsized on the upside. You can wait. I'll wait a year or 2 or 3 or 4 or 5 for the returns that they're gonna give. And I talked about a book that I did years ago. Again, Eric Sprott, and Eric told me, he said, the reason I like the mining sector is because he said the lows are so low and the highs are so high that the difference between the two is hundreds and hundreds and hundreds of percent. He said there is no other sector in the world that you can get those sort of outsized returns if you are just patient. And so that's what I looked at with uranium. I mean, I didn't know all these fundamentals were going to get more positive, but in the markets, remember, you don't have to have things get more positive to make money. You just have to have things stop getting more negative, right? And if you can just feel the puking in the market, and the people who bought all on the way down, and they just don't want it anymore, and it's so hated, and the sector is down 80%, that's the time to start looking around, because so obviously at this point in the uranium cycle, the returns from this point going forward are not as great as the returns were from the bottom. But I still think we're going to see good returns. What's important though with uranium, and I think this is extremely important for the listeners, uranium at this particular time has become a risk asset, right? So the stocks are getting hit pretty hard, along with the technology stocks and all the other risky stocks out there. I don't think it's deserved, but it doesn't matter whether it's deserved or not. It's happening. Mm-hmm. So, uranium stocks are under pressure when risk assets are under pressure, and that's not necessarily the case with gold stocks, right? They kind of get lumped into that risk asset sector. So, you might see them under pressure for a while until the Fed does a 180 and starts to, print some more money, et cetera. Then money might come back into the sector. It could diverge, but right now it's acting as a risk asset, and that's great, because I think if you look 3 years out, there's great opportunities there.
Mm-hmm. Bob, uranium has, in the public sphere, has really fallen out of favor, and with the move of all these ESG mandates and attitudes coming into the sector, do you think that creates really an opportunity for investors?
It really does, in a backwards sort of way, which is fascinating. You look at what's happened with oil here, right? And I always look for instances in the past that are similar, and it's hard to find sometimes. But this one was actually produced by an analyst I have a lot of confidence in a while ago. And we kind of look back in the past, and what's crazy is 2 years ago, oil was minus $20 a barrel, right? And now it's up where it is. But because of the ESG principles, and I don't think anybody's arguing that we want a cleaner world, but because of denying people the capex and ESG mandates and people saying don't invest in dirty energy, these companies have not been able to spend a lot of capex in an asset that you have to go find more oil. So obviously we're in a situation now where demand is fine, but the supply is shrinking, right? And we don't have this easy money anymore. We had it in the shale, right? Everybody thought shale was going to save the world, but I said, back in the US there, I said the only reason that shale companies are increasing production dramatically is because they have easy money. Again, a central bank dictated policy, because money was so easy, they were lending to these shale companies. And I was saying, the cost of production, the depletion on these shale companies is 60-70% a year in the first year. So they got to keep going and finding more oil, and they had the access to capital to do it. So it was like a mouse running on a wheel. They were staying very, very, very busy, but they weren't going anywhere. So that's all come to play now. And now we have supply issues, and these companies are cash flowing dramatic amounts of money. So we looked at something, this analyst looked at back in the past, and what was the oil back in the 80s? It was tobacco, right? Everybody said, obviously. They put the pictures, and you see the rotting gums and things like this on the all this regulation that happened with regard to tobacco. So because of that, it actually created a moat around the industry and barriers to entry. Nobody was going to start a tobacco company. Why were we going to do that? It was a horrible industry. So the companies that already had a foothold in that area were like Rothmans here in Canada, or in the US, Philip Morris, actually had a moat around their business. They had an industry that people weren't going to compete with, and an industry where people continued to use the underlying product that they had. Mm-hmm. So you look at Rothmans here, from December 1987 until July of 2008, the stock was up 12,000% compared to the TSX on the blue line. And that's a very similar chart for Philip Morris in the US. Who would have thought over 20 years that these companies in an industry as horrible as tobacco, as far as reinvestment and people putting more money into the sector, we're going to give these sort of returns. But I think what's really important and what happened, and we're starting to see this in energy right now, and why we probably have a very long, good energy market ahead, is exactly the same things have happened. There hasn't been any investment in industry. There's a moat. We're still using dirty energy because we have to, or we can't make the transition tomorrow. But what companies do is they don't reinvest back in their own business because it's not politically correct or whatever the case is to do that. So if they're not reinvesting back in their own business, they're paying out special dividends. So you see Rothmans here give a dividend increase. All those red triangles are dividend increases. And they give special cash dividends when they actually have so much cash on the balance sheet, they just give it back to investors. So you get all the special cash dividends and dividend increases. So that it just increases the return to the underlying investor more. So I thought this was a great example to show because regulatory and social barriers were very, very similar to what we're seeing today with regard to energy companies. Now, I also think that's going to be the case with mining companies, not to as large of an extent as energy companies, but still, a lot of people out there don't like to see a big open pit in the ground and what it does to the earth, et cetera. But this is a necessity, and I think that's why we see these supply shocks coming. Right, we have these charts of copper and the amount of discoveries that have been made. It just isn't there for the demand that people are going to have. So this is a copper, and you see the exploration budgets are way down below what they were in 2010 and 11. Right, they're not nothing, but they're way down below. But you look at the number of discoveries, there hasn't been any. Right, and these big copper mines in Chile that have been going for 50 years, the grades are half of what they were before. So technology's improved, so it's profitable, but that can't go on forever. And if we are going to make this ESG transition, I think everybody kind of knows this. We're going to need a lot more copper. And we're going to need a lot more industrial metals going forward. But I think this is very interesting because this could have been the same chart for oil 2 years ago. Right? People say, okay, we want to get off, dirty energy. But it's going to take a decade or two to do it. How many new discoveries has there been? How much money has been spent in the sector? And we would have saw this sort of chart. And then you saw what happened to oil prices. So that's why, I think we could be on the cusp of that with mining also.
Bob, it's kind of counterintuitive to see the exploration budgets go up, and yet the discoveries just keep going down. Is there a particular reason for that? Or is, the easy copper, the high grade, or the thereafter, that's all basically gone?
Yeah, the easy deposits have been found, whether it's gold or copper or whatever the case is. There are some, examples where that's not the case, like the Golden Triangle in BC. I mean, there's been some discoveries where they found 27 million ounces in the past couple of years, or whatever the case is. But they're few and far between. The big deal is with mining that isn't the problem with oil and gas, is that when you make a discovery, and there hasn't been many, there's permitting issues, there's all these issues that are barriers to you actually getting to that final phase. The Congo or other countries in the world where the governments change a lot, and there's a lot of risks there. So the prices have to be up to certain levels for you to take those risks. So that's kind of what we see on the mining side. I think the amount of discoveries is low, the amount of capex is relatively low, and the demand is increasing. And I don't think anybody a few years ago saw this electric car revolution. But now that we see this, if it is going to continue, we just don't have the industrial metals to take care of that.
Yeah, all of those base metal demands, energy demands, and then if we lump in how much debt has been created in the system, all of that seems to all be positive for the commodity sector as a whole, and really the base metals and energy metals and precious metals, right?
It certainly is, and I think that can create a secular bull market. The first chart that we looked at shows that we're probably on the cusp of that, maybe for a decade, but it could be even bigger than a lot of people expect, because the last one was a demand driven bull market with China. This is maybe a supply constrained bull market. And if there's going to be supply constraints, which I think we've shown probably in copper, there's going to be, and the other industrial metals, then that means we have sustained inflation, right? Because your input costs are less, which means stocks don't do well. Now, again, it doesn't mean hyperinflation. I'm not going to say we're going to be the Weimar Republic or that sort of thing, but all we need is inflation of 4%, 5% and sustained, and interest rates at sustainable at 2%. We have negative real rates, and we get a commodity bull market. Gold's a bit different, right? It isn't really used as a commodity, but it's a monetary metal, obviously. But I think it's interesting that central banks around the world are at 31-year highs with the amount of gold that they've been buying, and with the U.S. kind of confiscating some reserves that were done recently. I think countries are thinking, well, let's maybe have something else on our balance sheet as far as reserves are concerned. So that's obviously a positive for gold. The other one is silver, which is kind of a monetary metal and kind of an industrial metal. It's both, depending on how you look at it. But silver prices are still half of what they were at the peak, two peaks back in the early 80s and then 2011. So I think the silver market is such a small market that's again why I think it's a great place to be if you have patience, right? Because by the time it starts to move, and even a reasonable amount of money comes into the market because it's so small, the price is already up dramatically. So you kind of got to be there through the pain to get all the gain. Again, as I say in the markets, no pain, no gain, right? Well, you got to be. Sorry, go ahead.
David Morgan says, 90% of the silver move comes in the last 10% of the time, right?
That is exactly right. And that's if we were look at all the commodity markets in the past, you'd see that spike at the end, and that's why it's really, really important to look back at that mining clock, because the mining clock will identify that, and it'll identify, okay, this is the final spike that's happening, because you see all the internals in the market happening, the stock for stock takeovers, the euphoria, et cetera, and you can make a decision to liquidate and get out. And it'll be when everybody's most positive.
And not ride the cycle all the way back down as well.
Yeah, it's called the it's called the round trip, and people do it in this sector all the time.
Excellent, Bob. Well, I think that was a real deep dive into how you see things, how you value things, what you're bullish on. Is there anything else you'd like to touch on before we wrap up here?
No, I don't think so. I do a report for mining executives called the Gold Digger Report, which basically looks at their personal finances in relation to where we are in the cycle in the market, and their net worth that they've generated from the business. And we do that because, again, we want to be able to harness the gains in any cycle. If your retirement, it's same with any of your listeners, if the time when you want to retire doesn't coincide with a great time in the cycle, then you're not going to be retiring, right? So don't let outside factors control what you want to do with your life. Take control and make the decisions to get to your goals and objectives.
Is the Gold Digger Report available to the average listener, Bob?
It is, sure, it is. Yeah, it's certainly. So it's
how do they get a hold of it?
Sure, they can just email Thompson Investments at raymondjames.ca.
Okay.
So Thompson, THOMPSON Investments. Yeah.
And of course, you're available on Twitter at Bob Thompson RJ, and you have some links there as well, right?
Correct. Right. So I could be more active on Twitter, but in my industry here, there's compliance and that sort of thing, so I can't say everything I want to say. But
absolutely, Bob. Really appreciate your time and the energy you took to lay everything out for us today.
That's fantastic, Tom. I really enjoyed the conversation. I look forward to doing it again.
Absolutely. Take care. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.